Let's talk about Texas home equity loans and HELOCs, also known as a home equity line of credit. So first and foremost, they are different in this sense. A home equity loan just is a generic term for a home equity loan. Somebody's going to get a loan that's tapped into the equity of their home. That's a home equity loan. A HELOC, or a home equity line of credit, is a type of home equity loan. So technically, they're the same, but they're not. And here's why. There are home equity loans that are fixed rates. Matter of fact, unless you say the word HELOC, the vast majority of the time, you can assume a home equity loan, somebody is talking about a fixed rate mortgage, meaning like the loan and the rate and the payments are all set. And it's also a quote normal home equity loan, meaning that when you make payments, the balance goes down. And it also means the balance starts at a very upper end, like it starts at a normal balance amount and works its way down to zero. Conversely, meaning the opposite, home equity line of credits are different from that. So really what we're talking about today is the home equity loan versus a home equity line of credit. So again, just to be very clear, a HELOC technically is a home equity, but in this instance, we're going to assume a home equity loan means a quote normal fixed rate mortgage. So let's talk about the differences. So home equity loans as a whole, like I said, the fixed rate version of it, just assume it's like a normal mortgage. You borrow, and I'm making a number up. You borrow $50,000 with a home equity loan, and then you're going to have a payment that's set for a month or per month, and it's going to be for make it up 20 years. You're going to make whatever that payment is over the course of 20 years, and at the end of 20 years, your balance is zero. You can't go get more. You just pay on it. If you want to pay extra, you can, but that is a fixed rate, like just a normal mortgage. That's the home equity version. The home equity line of credit is a line of credit. So let's talk about what a line of credit is. Think of it like line of credit says, okay, if you want to go get access, so the keyword there, access to $50,000 in your home, you have access to it. It doesn't mean your balance is 50 grand. It just means you have access to get 50 grand. So the line of credit says if your balance is zero, like a credit card, if a balance is zero, there's no monthly payment. But if you were to go get 20 grand of this 50 grand example, then all of a sudden next month when the mortgage payment comes due, you will owe a mortgage payment. Home equity line of credits typically, and again, you guys can check out the details. There's another page about that. It has more and more details about this, but as a whole, it's going to be interest only payments for about 10 years. And then after 10 years, it becomes fully amortized principal and interest loans. But for the first 10 years, you get this really cool flexibility where the balance can go up or down every single month. And then your mortgage payment each month is based on how much you actually owe. So a line of credit says, okay, I'm going to go get that 50,000 available to me. I'm going to pull out 20 this month. I now make a payment according to that 20. Next month, if I pulled out another 5 for a total of 25, my payment goes up from the previous month because now I owe 25 grand. Then I pay off 15 grand, let's say the following month after that. Now my balance is only 10. So my payment goes down considerably to only the 10 grand balance, and I'll write the check for that each month. So every month your payment could be different based on how much you do or don't pay and how much you pull out of the home equity line. So that's a line of credit. And to be a home equity line of credit, it just means that it's tied to your home. It's a mortgage. Most often, but not all the times, but most often these are second liens, meaning you already have an existing mortgage. Typically, let's just call it a plain vanilla mortgage of the first. That's make up an example, 300 grand. And now you go get a $50,000 second mortgage. And that's the HELOC in this example. So HELOCs are wonderful tools. They give you lots of flexibility. Let's talk about like when you should versus shouldn't. So guys, here's what I'll also tell you. Call us, call the Mortgage Mark team. We'll walk you through which one may be right for your scenario. Because what I'm about to describe is kind of generic. They're fundamental principles, they're guides, but they're not necessarily the way. This isn't the map that say you have to do these things and this is what you should do. So keep that in mind. So the HELOC, home equity line of credit, it's good for flexibility. And when should you get it? So Mark Pfeiffer's opinion, right? Having done this for over 2 decades, my opinion is that HELOCs should typically be done with a couple of different use cases. One is if somebody needs not a lot of money, and that's relative, right? Because 50 grand is a lot of money, but 50 grand compared to 500 grand, those are two different numbers, right? Big number versus little number. So if it needs 10, 20, 30 grand, something like that for maybe some home improvement loans to pay off some debt or whatever it is, just have as a backup, home equity line of credits are great for that. I think is a good example. And the reason why, because if you get too big of a balance, HELOCs, as I mentioned, more often than not, are second liens. the second liens are going to have a higher interest rate than that of a first lien. So if you want 500 grand, it may be better to do a normal, air quotes, normal home equity, like a fixed rate where you do a cash out on your home instead of doing the HELOC second. So typically smaller amounts, and that, yes, that's relative, right? So that's one part. Next is maybe for shorter term money, meaning like, man, I just need 20 grand to pay off some credit card debt and get out from behind that. But I know that in the next, this time next year, I'm going to get my bonus again. I can use that to pay off the rest of it. I'm going to get a pay raise, or my wife goes back to work after having a baby, about to have an inheritance, something like that, to where it's like, look, I don't need the money forever. And the reason being, guys, big thing that you got to understand about these home equity line of credits is that their interest rate is variable. It changes when the Fed changes their interest rates, which brings me to a third one. In a rate environment where rates are really high and expected to come down, HELOCs can be really good. So at the time of this taping, the Fed has already announced or about to announce that they're going to reduce rates and start reducing probably for the next foreseeable 12 to 18 months. So in this example, if somebody gets a HELOC today, over the next 12 to 18 months, the interest rate on that HELOC will go down each time the Fed changes their interest rate. So in a rate cycle where rates are coming down, HELOCs can be good. But let's rewind and go back to COVID when rates were just crazy low. Well, at that point, maybe somebody doesn't want a HELOC because that means that every time the Fed increased rates after COVID, because they needed to increase to cool down the inflation. So the HELOC can get more and more expensive if you do it in a rate rising environment. So as the cycle comes down, that's good. So let's recap real quick. So smaller balances are usually good, maybe shorter term, because again, you don't want these things for a long, long time because you don't know where the rates are going to be in the future. A lot of times HELOCs are good for just in case, the rainy day fund. So Karen and I, we had a HELOC for many, many years on our old house, never used it once, but it was nice to have it there. So I would say if you have seasonal cash needs, maybe at the end of the year, when property taxes come due, you want to make sure you have access to cash in case if you're a business person or a commission person, maybe that's the light time of year to have that kind of seasonal need for it. Pull it off. Your business owner, maybe there's a busy time of the year where the cash flow, comes in, but then later on it's low and you might need just that extra little boost. That could be some reasons why you need it. And then lastly, when it comes to how much should you get, in my opinion, right, depends on the person, but if you're getting a HELOC, get as much as you can. Because remember, access to the cash doesn't mean you have to make the payments to the cash. So in other words, again, if I have access to 50 grand, or in my case, my personal case, when I had access to, I think it was like 90 grand, I never used it, which means I never had a payment on it, but I had access to it. So you might as well go and get the biggest amount, knowing that you got the biggest safety net you need. And then lastly, when you don't know your timeline for something, that's another reason why the HELOCs can be good. So for example, man, I'm going to need to do something, whether it's, trying to think of a good example about this. I know that I'm going to need 30 grand, give or take, to remodel my home. And let's just pretend in this case, the HELOC made more sense than home improvement loan, because there is a difference to that. And I'm sure there's more videos about that you can check out from our page. But if you don't know when that 30 grand is going to be due, or maybe there's an investment that's coming up that you want to invest in, although mortgage folks aren't supposed to encourage that. But let's just say there is that example of 30 grand for your business. How about that? There's a need for 30 grand worth of equipment, but we don't know if that's going to be 6 months from now or 12 months from now or 18 months from now. Again, the HELOC makes it great because you have access to it and you don't have to pay interest on it, versus if you got a traditional, pardon me, home equity loan, the second you get that money, you got to start making a check, a mortgage payment on it. So HELOC says no payment, no balance, no payment. So I think for all those reasons, a shorter term, a smaller balance, seasonal cash needs, when you don't know how much you need, get a bigger dollar amount than you think. For all those reasons, I think it makes a lot of sense for HELOCs in those circumstances. But again, feel free to call us. It probably is going to be about a 15 to 20-minute conversation to figure out what it is you need and want, and we'll point you the right direction. Sometimes we do them. Sometimes we refer you out to other banks and other folks we know that do them really well. It just depends on the need and what you're looking for. So in terms of underwriting, qualifying, and it's normal stuff, guys. You're going to show your income. You're going to have to show some assets. I will say the HELOCs oftentimes may have a little bit less paperwork than it was if you're doing a quote normal home equity loan with a first lien mortgage lender like us. But if you go to a local bank, maybe it's less. And it's not because it's less because it's like they're better than us. It's just when you get a first lien mortgage, there are typically bigger dollar amounts and there's different underwriting process, versus these HELOCs are often little more local banks. And while they have somewhat less paperwork requirements, they're also much tighter on what they will and won't allow. And that may be where we come in to help you out to say, look, if that, when we send you to bank A, B, or C, if you're 0 for 3 and they can't do it, come back to us, then we might be able to help you out. Less favorable terms sometimes, depending on what broker channels we use. But the reality is, come to us first. If it makes sense, we'll help you. We'll point you in the right direction, and we'll go from there. But beyond that, the fees, again, there's a whole page on HELOCs, especially Texas A6 stuff. So check that out too. That gives you more details about the actual HELOCs. But this, hopefully gives you an understanding of when to do a HELOC versus a home equity loan. Again, the home equity loans are going to be, just to recap and say the opposite. Home equity loans are for bigger loan amounts, things that you want long-term. You're not sure when you're going to pay them back. And then also, if you just have a first rate or a first lien with maybe a high interest rate like 7 or 8%, and rates can be refinanced now lower, maybe it makes sense to do a HELOC and just get cash out while you're also refinancing your home. So again, a lot of moving parts. Hopefully that helps. If you guys have any questions, just to reach out to us and let us know how we can help you. But thanks for watching.